All right, everyone. Welcome back to our tutorials on Forex basics here at NurreFX. For our next lesson, which we're going to be going through money management, mainly position sizing being a very important subject matter when it comes to managing risk in your account. So before we even get started into position sizing, I think it helps to go through a little bit of trading mentality or a little bit of brief explanation on what money management is or risk management. What is money management? The ability to manage risk parameters in your trading methodology. You've probably heard the cliche term before, cut your losses short, let your profits run to an extent. But essentially, people ask me all the time what the secret to Forex trading is. Or I don't think there's really any secret to any type of trading. I think in order to be a successful trader, you have to have a proper mindset when it comes to managing risk. I think you can be an average trader, an average to good trader. You still have to be able to pick out good trades, but if you can manage your risk and manage your account and manage your money good, then you can become a great trader because that's what it's all about in Forex trading. It's not a sprint. It's a marathon, if you will. This is not get rich quick. It's something to where you make a commitment to becoming a money manager, essentially, when it comes to trading in any type of investment vehicle. When we talk about reasons why traders fail, and trust me when I say that there are quite a few traders in Forex trading, especially that fail. Some people will say anywhere between 80 to 90% of retail Forex traders lose money. And I think there's some really simple explanations as to why. Risking too much capital on a single trade is a big one. People kind of get that get rich quick mentality, and they open up a Forex account. They get all excited about what they're doing. They place a trade, and they lose a huge amount of their trading capital in one swoop. And that's certainly not the way that we want to go. Failure to use stops. Essentially, stop orders are orders that protect you in the market. Stop orders essentially you admitting where you're wrong on a trade. So some people might say they use mental stops or whatnot. When you get into a trade in a leveraged market, you have to be able to admit where you're wrong. So a stop order is an order that takes you out or closes your trade as a trade moves against you. And so people that don't use those often they lose money very quick in the Forex markets. Never realizing profits. I've seen people take short-term trades and turn it into long-term trades by never taking money off the table because they get too greedy. You have to have a really good plan when you get into a trade, not just where you're wrong and how much loss you're willing to sustain on a trade through a stop order, but also being able to have a good profit-taking level in mind to where you're taking money off the table. Unfortunately, like your mortgage company does not allow you to make your house payment off of money that you have not realized in the markets. Disorganization, that's kind of an obvious one. People just kind of trading off the seat of their pants. Lack of discipline. This all boils together. All of these things you can put into kind of a the main theory behind money management, because you have to be very disciplined. You have to be very patient in what you're doing. You have to be very organized in your thought process and the way that you set up your orders. So the first subject matter when we get into this is probably the easiest rule or set of rules to follow in trading. Before you even get into placing orders and where do I get in, where do I get out, you have to have an idea in mind of, how much of my account am I willing to put up as risk on this individual trade? It's probably the easiest thing to follow in Forex trading. As far as the calculation goes, it's not very difficult, but it's probably the most difficult thing for traders to be consistent on because they're never consistent in the amount of capital that they risk on a trade. So percentage of capital is essentially a predetermined percentage your trading capital that you designated as risk on individual trades that you put in. When it comes to professional traders, retail traders, generally my rule of thumb is depending on how your trading's going, whether you're on win streaks or losing streaks. Most professional traders and retail traders do not want to risk more than 1 to 3% of their capital on a single trade. Now, that doesn't mean that you can't have multiple trades on, but you definitely do not want your account to blow up. If you get on a 3 or 4 trade losing streak, you definitely don't want to see your account being down 40 or 50%. That's why the percentage of capital rule, as we call it, is so important. I always say never risk more than 5%, and that's generally in a given day for me. If I'm trading intraday, if I have multiple trades on, I try not to put more than 5% of my overall account at risk on all of my open trades. But that's just a kind of a personal rule of thumb that I call a daily stop loss limit. If I'm trading short term in the markets, I never want my overall open trades to have more than 5% of risk out there in the market, or 5% of my risk capital out there in the market. One of the things, and you've probably seen this before if you've ever gone through a money management class, is when people are trying to risk more than their account, more than certain percentages of their account. Say this is just an example of risking 10%, because some people will risk even more than that on trades. Believe me, you do get on losing streaks sometimes in the market. They're not fun. This is kind of an extreme case of a losing streak, to where if we started off with $5,000, and let's say you're trading, you're risking a large amount of your account. You lose 10 trades in a row. Pretty extreme example, I know, but generally you're going to have at least 1 or 2 wins in there. That would be a pretty bad losing streak. Well, consistently trading with 10%, if you lose 10 trades in a row, your account's down 65% after 10 losing trades. And pretty much I can tell you what you're going to do from there. You're either going to double down and try to get it all back, or you're going to close your account and say, you know what, the heck with this Forex trading, I'm not going to do it anymore. Even going to risking 5%, which this is, I don't risk more than that in the overall account for all my open trades. But for individual trades with $5,000, if you're risking 5%, your account's still going to be 40%, down 40% after 10 losing trades. And that's not bad, but it's definitely not good. I see that from a mentality of trading, that once somebody loses like half their account value, generally that's when retention becomes a problem with brokers, to where they close their account. It turns into too big of a drawdown for them to recover from. Now, if we're risking 2% of that same capital, you can see, even if I get on a bad losing streak, after 10 trades, I'm only going to be down 20% after 10 losing trades. And this is a really, this would be an area where we're doing some really bad trades if we lose 10 trades in a row. But 20% is actually not that, it's not a huge drawdown. It's not digging ourselves into a pit, if you will, to where we can't recover from that. So that's why it's so important. Remember, this is a marathon. It's not a sprint. You're not looking to double your account in one trade. You're looking for good rates of return on a consistent basis, on a week-by-week basis, on a month-by-month basis, on a year-by-year basis. And you'd be surprised if you kind of take things slow and risk smaller amounts of your account, of how fast your money can grow as you gain more experience in Forex trading. So position sizing basically means, how many lots am I going to put on a trade? Once I want to put a trade in, and I know approximately how many pips I want to risk on a trade, how many lots am I going to do? How big of a position can I take on this based on my risk? Essentially, the calculations to get to how many lots you can do is a percentage of your trading capital, a predetermined percentage. Say you want to risk 1% or 2% or 3, and then you divide it by your dollar amount of risk per lot. Dollar amount of risk per lot is actually very simple. Because we've gone through pip value, which you should already know, the dollar amount of risk per lot, you take the pip value of the pair you're trading and multiply it by the amount of your stop order. say I'm trading with, the pound dollar pair where I'm trading mini lots, and those mini lots, the pip value on the pound dollar is going to be $1 per pip, and I want to risk, let's say, 50 pips. Well, I take that 50 pips, I multiply it by $1, the pip value on the pair, and it's going to come to $50. So that's going to be my dollar amount of risk per lot. So let's go through an example of this, and then in our next lesson we'll be going through a live example of position sizing using a live account. So let's say that we're using a 2% rule. So we don't want to risk more than 2% of our trading capital, and we have a $10,000 account. We're going to be buying mini lots on the euro dollar, and let's say when we put in our trade on the euro dollar, we're going to risk 30 pips. We're going to put in a 30 pip stop order, meaning when euro dollar goes down against me by 30 pips, if it does, they're automatically going to close my trade out. Well, the way we get to this is we know we only want to risk 2% of our account. So 2% of our $10,000 account is going to come to $200. So that's the maximum total amount of risk we can put up on this trade. Since we're putting in a 30 pip stop order, we multiply that by $1, which is the pip value on the euro dollar pair, because the dollar is the quote currency. That would be a direct rate transaction for me here in the US. So 30 times $1 comes to $30. That's my risk per lot. And then all we have to do is divide those out. It's as easy as that. We can't risk more than $200 of our account. For every lot that we put on, we're risking 30 bucks. So we divide that out and it comes to 6.66 lots. In trading, generally, the rule of thumb is if you have, let's say, 6.6 lots, you always round down on your risk. That's a good rule of thumb. You never round up to risk more. You always round down to the nearest lot size to risk less. So in this case, if you're trading in just mini lots, you would round down and you can buy 6 lots on that trade. So the question I would have for you if you're watching this tutorial is, what does this help you do? Well, we all know that it helps us manage risk, and we all know that it helps us manage our money, but it also helps us to live to trade another day. Meaning if we lose on this trade, it's not going to totally blow up our account. We're not going to lose a huge amount of sleep on it. I get emails sometimes from some of the students that will come through my live trading room, and it's not all the time, but usually it's more inexperienced traders that will send me an email and say, hey, I really got crushed today on that pound dollar trade or on that euro dollar trade. And I'll often email them back and I'll say, you got crushed? How much were you risking on that trade? I trade live with my students so they can see my face. When I lose on a trade, I'm not happy about it, but I'm not about to go jump off a building either, because it's, I've lost only 2% of my account. I've lived to trade another day, by managing my position size. It's very important. This is one of the hardest things for Forex traders to follow. It's an easy calculation, but it's really hard for people to follow these types of rules on a consistent basis, because most people give in to greed. They may lose a couple of trades in a row. They'll get greedy. They'll say, you know what? I want to double my account on the next trade. So I'm going to go in and do, let's say I have a $10,000 account. I'm going to go and do 9 standard lots on a trade and try to hit a home run out of the park. And that generally does not fare very well for people when they try that. Now let's talk about multiple positions. So let's assume that we put this euro dollar trade into our account. Well, let's say we're doing multiple positions, meaning we have our euro dollar trade in, it's executed, we're long on that position, but we see another trade that looks good to us. Well, in this case, if we're trading multiple positions, you want to factor in your existing, or what we call your open risk, on your next trade. So in this account, if we have a $10,000 account and we were to place that trade and it's an open trade on the euro dollar, when we go in to do another trade, do we still have $10,000 in our account? Let's assume we haven't moved our stop. We have our same take profit level in. Do we still have $10,000 in our account? No. You kind of always go and look at it as a worst case scenario in your account. So in this case, as an example, in our $10,000 account, if we were wanting to place another trade, the open risk that we have on the euro dollar with our 30 pip stop order sitting there is if we get it, we have to assume we get stopped out, we would lose $180. So that's our 6 lots because we rounded down times the $30 of risk per lot. So in this case, our new capital is going to be $9,820. 10,000 minus 180 comes to 9,820. So that is the new amount of trading capital that we have in our account. So if we're going to buy let's say the Aussie dollar, and we're going to use a 40 pip stop, we would now take 2% of that 9,820, and it's going to be a little bit less than that $200. It's now 196.40. If we have a 40 pip stop, we multiply that by the pip value, so that's $40. We divide that out and it comes to 4.91 lots. So in this case, again, once again, we would buy 4 mini lots of the Aussie dollar. We would round down. Again, very, very simple math in this. And this is one of those things that if you can build consistency on your lot size, on every trade, of managing your risk and making sure you don't risk more than a certain percentage of your account and stay extremely disciplined in that, then you're already off to a good start. If we start you off as a money manager, meaning as a good risk manager, if you will, then from there trading gets a lot easier. Trading in general is hard because you're never going to be 100% accurate, but if we can start you off with good risk